Hello everyone, I'm Jeff Brickman, Senior Investor Liaison at the Financial Accounting Standards Board. Thanks for joining us for this podcast for investors, where we will address the impact of the new revenue standard on financial reporting in the software industry and answer some questions you may have about the new standard. With me today are FASB board member Marc Siegel and Assistant Director Cullen Walsh. But first, before we begin, I'd like to remind everyone that the views expressed in this podcast are the personal views of each of the participants. Official positions of the FASB are reached only after extensive due process and deliberations. Marc, can you give a high-level overview of the new revenue model and how it applies to software?
Thanks, Jeff. The new revenue recognition standard introduces a comprehensive model for companies to use in accounting for revenue when you have a contract with a customer. This new model is a collaborative effort between the FASB and the International Accounting Standards Board, and it will apply to companies globally. The rules around recognizing revenue under previous GAAP have evolved over many years, like the tax code, and so there are sometimes different rules for different sectors. Also, when new business models come up, there has been a need to add a new patch to the revenue guidance. So, one of our objectives with this new model is to improve consistency and comparability in revenue recognition across different sectors. One way we accomplished this objective was by creating a robust, overarching framework for addressing revenue issues. This lets us do away with the current industry-specific or transaction-specific guidance that sometimes results in very different accounting for economically similar transactions. I also hope it can support new business models which develop going forward. Obviously, software companies will be subject to the new standard. The core principle of this standard is to recognize revenue when or as the seller transfers promised goods or services to the customer. The amount of the revenue should reflect the consideration to which the company expects to be entitled. We've developed a 5-step model to help companies achieve that core principle. First, the company would identify the contract with the customer and ensure that a valid one in fact exists. Second, the company would separate out the promises to do something for the customer, what we call a performance obligation. Third, the company would determine the transaction price for the contract, which is particularly tricky when there's variable pricing involved. Fourth, the company would allocate the transaction price to each performance obligation. And fifth, the company would recognize revenue when or as a performance obligation is satisfied. The biggest change to software revenue recognition likely is in identifying the performance obligations the seller is responsible for fulfilling under the contract. While the items a software vendor provides to a customer are not changing as a result of the new revenue standard, the guidance about whether the vendor should account for each of those items separately or as a combined group of promises has changed. For the service elements in software contracts, for example, post-contract customer support or implementation or hosting services, those under today's rules are accounted for separately from the software license only when the company has vendor-specific objective evidence of the fair value of those services. That's often called having VSOE. Otherwise, the software license and those services are accounted for as a single element, with the revenue for the license and those services generally recognized over time as the services are performed. Under the new revenue standard, companies will separate services from the software in a different way, based on whether the software and the services are each distinct. Sometimes they will be distinct and sometimes they will not. It really depends on the nature of the items being promised to the customer. Today, under current GAAP, a software company that is not able to establish VSOE for the related services, like the post-contract customer support, they would recognize all revenue in the contract ratably over the term of the post-contract support. However, if they could establish VSOE over the undelivered items, revenue from software licenses, whether it's perpetual or time-based, that would be recognized upon delivery of the software. It's important to note, though, that time-based licenses are frequently recognized ratably over the license term because it is often difficult for those companies to establish VSOE over services like post-contract customer support. Now, under the new revenue model, a company that cannot establish VSOE today, it still might be able to separate the license and the services into distinct performance obligations. So it might be, for example, the software license, installation services, and professional services. And if they could separate it out, they would recognize revenue separately for each component. In some cases, this will result in earlier recognition of some of the revenue in a contract. In other cases, though, it won't have much of an effect at all. But I hope that it better reflects the economics. In other words, it shows revenue as distinct promises to the customer are fulfilled. Cullen, anything to add to that?
As you mentioned, Mark, currently software revenue recognition is significantly impacted by whether companies are able to establish VSOE for services sold together with a software license. VSOE is a strict, rules-based determination. As a result, economically similar arrangements are accounted for inconsistently based on the specifics of the VSOE analysis. For example, two companies that sell similar software on similar terms might end up with very different accounting today due to narrow differences in each company's VSOE analysis. If one company concludes that it does have VSOE, then revenue for the software license might be recognized upfront. If the other company with substantially the same arrangement concludes that it does not have VSOE, then its software license revenue might be recognized over time. I believe that by moving towards a more principles-based approach, investors will receive more comparable information across companies for arrangements that are economically similar. It's also important to highlight another key improvement of the new revenue standard is the disclosure requirements. Today, GAAP has very few disclosure requirements for revenue. One of the focus areas for the FASB and the IASB's project was to improve disclosure about revenue recognition. New disclosures are required for significant judgments and estimates made about revenue recognition decisions. One final note, public companies are required to adopt the standard in the first quarter of 2018, but early adoption is permitted in 2017. I have heard from some companies that they plan to adopt early in 2017, but that remains to be seen.
Thanks, Marc and Cullen. Let's dive into some specific questions that investors might have about the impact of the new revenue standard on software companies. Cullen, some have expressed concern that the new revenue standard will cause revenue recognition to become less conservative, with a shift to more upfront recognition, and that companies could potentially manage their financial results through contract structuring. To start off, what types of software arrangements do you think will result in more upfront revenue recognition under the new standard?
Broadly speaking, it would be those arrangements for which companies recognize revenue over time today because they could not establish VSOE for a distinct service, such as post-contract customer support or hosting. Under the new guidance, those arrangements likely would include distinct performance obligations which could be separated for revenue recognition purposes. However, it's important to remember that arrangements will only be broken apart under the new standard with revenue recognition separately if the elements of the contract are truly distinct from each other. There is even the potential for some arrangements that are separated under VSOE today to not qualify for separation tomorrow if the goods or services are not distinct. In those cases where they are not distinct, the revenue would be recognized over time.
So without the strict VSOE guidelines in current GAAP, what safeguards are in place to deter different companies from applying different accounting to similar transactions?
There are accounting policy elections and judgments involved in revenue recognition today, just as there will be different ones under the new revenue standard. For example, Jeff, establishing VSOE today involves judgments each software company must make, including a choice between two methods for establishing VSOE. Those two methods might not always yield the same results. This means today there is some variability among companies and inconsistent accounting for similar arrangements. I believe that the new standard also acts as a safeguard because while it allows judgment, it does not permit a free choice in applying the guidance.
Also, if I could jump in here, it's important to remember that there are safeguards built into the U.S. capital markets to prevent inconsistent outcomes. Things like companies' internal controls over financial reporting, auditors, regulators for companies, regulators for the auditors, and the development of industry practices all play a role in bringing about more consistency. And let's not forget all of the investors and analysts who will be probing companies to understand the reported revenue numbers and asking questions when things don't make sense.
On that note, What safeguards prevent companies from cherry-picking one type of contractual arrangement versus another in order to get that accounting treatment that they want? Could a company opt for contract terms that would cause upfront or overtime revenue recognition, depending on if they need revenue in a certain quarter, or prefer to defer revenue to a later period?
You know, Jeff, I'm not sure that any accounting standard could prevent that kind of behavior. If a company is able to successfully negotiate a particular set of terms and conditions with a third-party customer, and the company accounts for those arrangements and conditions faithfully, in my view, that is not a weakness in the accounting standards, because the accounting would accurately reflect the economics of the transaction. Also, Jeff, based on my experience, in some respects, it's actually easier for a company to structure a contract around a bright line test like the ones that exist today, as compared to a clear principle. This is because under a bright line type of test, the contract either did or did not meet the rule. End of story. At least with an overarching principle like we'll have under the new revenue standard, a company and its auditor would have to step back and evaluate whether the accounting conclusions make sense in light of that overarching principle.
Some have expressed concern about the software revenue recognition abuses which occurred a while back before the anti-abuse provisions, such as VSOE, were added to the software revenue recognition guidance. Could you comment on the environment under the new revenue recognition standard compared to when those rules were put in place, and the effects of moving away from the anti-abuse provisions included in current GAAP?
Given the financial reporting environment prior to SOP 97.2, I certainly can understand the concern about eliminating some of the anti-abuse provisions, such as VSOE. However, I think it is important to remember that the framework and guidance in the new revenue standard is significantly more robust than the base guidance that existed before SOP 97.2. There is a more robust model for separating promised goods and services in the contract from each other under the new standard, and there's also more stringent guidance on allocating consideration among the various promises in the contract, a constraint on recognition of variable consideration, and a continued prohibition on upfront recognition of revenue for sales and usage-based royalties for software. There also is a robust disclosure package that will provide more transparency than exists under current GAAP for revenue issues.
Also, I think you really have to consider the shift in the regulatory environment since the early 90s, including the passage of the Sarbanes-Oxley Act in 2002. Companies have to have much more infrastructure around internal controls today, and those controls are reviewed and opined on by auditors. I think that all of those factors reduce the risk of the abuses that we experienced previously.
Now, taking a step back to differences we can expect under the new model, will bundled maintenance and support be split into different elements and recognized differently?
In general, Jeff, no. We've discussed this very issue with members of our resource group advising us on implementation issues, and we've come to a consensus that both technical support and when and if available upgrade rights generally would be considered stand-ready obligations and recognized over time, and that's consistent with today. So I generally would not expect post-contract support revenue recognition to change for those companies that have VSOE over that support today.
Do you expect a change for those companies that do not have VSOE today?
Yes, there might be a change for those companies that don't have VSOE today, but only to the extent that those companies can demonstrate that post-contract support is distinct from the software license itself.
I think this scenario is a great example of how the new standard will reflect the economics of similar transactions in a similar manner. Today, a fairly minor difference in a VSOE analysis can result in some really different revenue numbers in the income statement.
Would you say that less license and services revenue will be deferred in complex license arrangements where services are currently bundled with the licenses?
Jeff, I would not expect a significant shift in the amount of revenue deferred. Under the new model, customization and complex implementation services are not likely to be considered distinct from the software license. In those scenarios, just like current GAAP, the bundled license and services revenue will be recognized over the period that the services are performed. Also consistent with today, companies generally would separate a portion of the total arrangement fee for any hosting or post-contract support services and recognize that portion of the total arrangement fee as those services are performed.
Thanks, Cullen. Another concern that I've heard is that the new revenue standard will reduce comparability across companies. So we are now going to address some questions where comparability could be impacted. One area where this could be a factor is software subscriptions. Under the new standard, will software subscriptions be separated into software available today and the value of upgrades for revenue recognition purposes?
In some cases, those companies applying subscription accounting with overtime recognition today may now be required to recognize license revenue upfront, separately from the right to when and if available upgrades or when and if available unspecified additional software products. In general, any company that applied subscription accounting because they did not have VSOE over upgrade or additional product rights will need to evaluate whether its software is distinct from those rights under the new model to determine if separate revenue recognition is appropriate. However, Jeff, it is incorrect to assume that all of those companies will conclude that their licenses and upgrade or additional product rights are distinct. In many cases, the elements would still not be separated because the license and the upgrades represent a single promise to the customer.
So would you say there could be inconsistencies between companies in how this is determined?
There could be some inconsistencies because there is a significant amount of judgment involved in the evaluation of whether goods and services are distinct. Reasonable individuals, in some cases, could reach different conclusions about whether a software license and upgrade or additional product rights are distinct. However, I think that in many cases, the guidance and examples in the standard should lead companies to similar conclusions for similar facts and circumstances.
It's important to understand, I think, that there are also inconsistencies under current GAAP that affect comparability. For example, establishing VSOE under today's rules is really a compliance-driven exercise. VSOE is tested using more than one acceptable method, and the results of those methods will not always be the same. Finally, even within the VSOE approaches used today, there are significant judgments involved for which different companies might conclude differently. So it's incorrect to think that there is complete uniformity under the VSOE regime we have today. In my view, if a company today wants overtime revenue but could probably establish VSOE, it's not too difficult to add a feature to the contract or even just extend the payment terms to get that overtime accounting. Other companies today, which have very, very similar contracts, conclude that they have VSOE and get revenue up front.
That's a good point. So for these types of arrangements, can companies change the way revenue is allocated to separate software and services performance obligations over time?
The allocation of revenue between software and an upgrade or additional product rights may change over time, but it's important to note that it's not a choice. Companies must establish estimated standalone selling prices based on all available observable evidence. As we mentioned earlier, Jeff, there are other safeguards in the system that are designed to ensure that companies are making appropriate judgments.
Based on our discussion so far, it's clear that judgment plays a significant role in revenue recognition under the new standard, and current GAAP for that matter. What types of disclosures will be made that could help provide investors with information around judgments and assumptions made and how they result in upfront recognition versus ratable recognition?
In general, you might expect a software company to separately break out the license revenue from services. The service revenue would likely then be further broken out between professional services, like training or customization, and post-contract support services, like when and if available product upgrades. A software company also would be required to disclose its key estimates and judgments in applying the guidance. For example, its method used for determining standalone selling prices, and key facets of its contract separation evaluation. There are many other quantitative and qualitative disclosures that were developed with significant investor involvement that are designed to provide enhanced transparency as compared to those provided under current GAAP.
Yes, it definitely seems like the expanded disclosure requirements are going to provide a lot of useful information. Some have expressed concern about the impact the new revenue standard could have on the income statement related to costs. If upfront recognition is required for a software license under the new revenue standard that was accounted for ratably over time under current GAAP, would it create a mismatch in timing with the associated costs?
Under the new standard, I think companies will still generally defer a significant portion of the arrangement revenue for post-contract support services or providing, when and if available, additional software products, even if the software license revenue is recognized up front. So, costs of providing the post-contract services, or when and if available software products, will be recognized in the same period as the related revenue. It's also important to remember that today, most of the costs associated with developing software are expensed when the costs are incurred, and that guidance isn't changing.
Another area I'd like to touch on is the treatment of discounts to the customer and the changes we can expect in the new standard with the VSOE guidance being eliminated.
The new guidance requires that discounts be recognized proportionally based on the standalone selling price of each element in the arrangement. However, in practice, discounts often might be allocated entirely to the license because I expect that many companies will estimate the standalone selling price of licenses using the permitted residual approach. This residual approach is very similar to the method used in today's guidance. It was largely included in the new revenue standard specifically for things like software licenses, which frequently are sold at widely varying prices.
Thanks, Cullen. The final area we're going to address in this section relates to variable pricing in an individual contract with a customer. How does the standard address a case where the price might change?
Under current guidance, revenue is generally not recognized unless the amount is fixed and determinable. Under the new model, revenue recognition can occur even if there is a potential variability in the transaction price due to a contingency. The company would make an estimate to determine the total transaction price, including the variable amount. However, the estimate would be constrained under the new model to an amount that is highly unlikely to be reversed in future periods.
Arguably, this is an area where more judgment will be involved than in current GAAP. But I think this actually opens the door to improved comparability among companies, because there is more opportunity for the accounting to reflect the underlying economics of the transaction by including relevant information in the transaction price.
Thanks, Marc. Finally, I'd like to take a few minutes to address concerns about the impact of the new revenue standard on software as a service vendors. Will SaaS accounting change as a result of the new standard? Specifically, will more revenue be recognized up front?
Generally, no. The timing of revenue recognition for those arrangements will not be affected. SaaS arrangements will still be accounted for as service contracts with overtime revenue recognition in the same manner as today. Hybrid SaaS arrangements also could be accounted for very similarly as they are today in most cases. It just depends a little bit. If a significant portion of the functionality of the software to the customer is cloud-based, the on-premise software license would likely not be considered distinct from the significant cloud-based functionality. So the whole arrangement would be considered together with the entire arrangement fee generally being recognized over time, just like in a pure SaaS arrangement.
Do you think that separation of software from a hosting arrangement will create comparability issues between native SaaS companies and flexible SaaS companies?
Companies will need to assess whether there is a software license in basically the same manner they do today under current GAAP. If there is no license, then it is a SaaS arrangement, which will not see different accounting than today. However, if a company provides a software license and hosting services, the hosting services will likely be distinct from the license unless those services provide a substantial amount of integrated functionality to the customer. In other words, the hosting services would work together with the on-premise elements to deliver a combined functionality to the customer. So some companies with arrangements of this nature that recognize subscription-style revenue over time today solely because of the VSOE rules could see a change. However, situations in which the cloud-based element is significant to the functionality of the overall solution will likely be accounted for in the same manner as today. In my view, the differences in revenue recognition patterns do not represent comparability issues, but rather reflect differences in the underlying economics of the arrangement, and the accounting should reflect those differences.
Thanks, Cullen. To conclude, I'd like to take a moment to discuss some of the key takeaways from this conversation. First, one of the primary benefits of the new standard is increased consistency in accounting for similar arrangements. Barely passing or failing a bright line test will no longer result in dramatically different financial reporting outcomes. Companies and auditors are going to have to consider the appropriate accounting in light of the principles. But we do have to acknowledge that the new standard requires the use of judgment, which is like current GAAP, and reasonable people sometimes disagree. Second, some of the issues we've discussed regarding the new revenue standard are actually not new issues, but rather issues which are also present in current accounting. For example, as explained previously in the podcast, opportunities to structure contracts for specific accounting outcomes also exist in current accounting, specifically related to VSOE guidance. Third, the new standard introduces additional disclosure requirements, which investors helped us to come up with, that were created with the objective of providing more transparent and useful information to investors. Thanks for joining us for this podcast. If you have any further questions, please contact me at jmbrickman@fasb.org or 203-956-5219. Additional information, including all of our contact info and further details around the standard, can be found at www.fasb.org.